Something is happening right now that Wall Street doesn't want to talk about plainly, and Washington certainly doesn't want you to fully understand. China has been selling US Treasury bonds, methodically, deliberately, and at a scale that should make every American pause and ask a very serious question. What exactly does it mean when your largest foreign creditor starts quietly walking away from your debt? That's what we're going to talk about today. Not the sanitized version. Not the version designed to keep you calm. The real version. The one that connects the dots between bond markets, gold, geopolitical power, and the future purchasing power of every dollar sitting in your wallet right now. Let's start from the beginning, because this story didn't begin yesterday and it won't end tomorrow. China's holdings of US Treasury bonds have fallen from nearly $1.2 trillion to around $600 billion, a decline of roughly 50% over the last decade. Now, that's the kind of number that gets thrown around in headlines to cause panic, and I understand why people react that way. But the real story, the one that actually matters, is not just the size of that number. It's the direction, it's the intention behind it, and it's the infrastructure being quietly built to replace what's being abandoned. As of early 2026, the global financial landscape is grappling with a tectonic shift in capital flows as China's major financial institutions continue a systematic retreat from the US Treasury market. Recent data confirms that China's holdings of American sovereign debt have plummeted to levels not seen since the 2008 financial crisis, signaling what many analysts are calling a definitive end to the era of deep financial interdependence between the two nations. Think about what that sentence actually means. We are talking about a relationship that has defined global finance since the 1990s, a relationship where China manufactured goods, the world bought them with dollars, China recycled those dollars back into US government debt, and everybody called it globalization and said it was working. That cycle is breaking down. Not all at once, not in a dramatic explosion, but steadily, brick by brick, like a wall being quietly dismantled in the middle of the night. Now, here is where I want you to slow down and think carefully, because the mainstream financial press will tell you one of two things. They will either say this is nothing, China is just rebalancing its portfolio, this is normal reserve management, the dollar is fine, go back to sleep, or they'll swing to the other extreme and tell you the dollar is going to collapse next Tuesday. Neither of those is true. What is true is something far more interesting and honestly far more consequential. What is happening is a deliberate, multi-decade strategic repositioning by Beijing to reduce its exposure to a financial system that Washington has increasingly turned into a weapon. The freezing of approximately $300 billion of Russian foreign exchange reserves following the Ukraine conflict in February 2022 served as a powerful wake-up call for Chinese financial planners. This unprecedented action by Western nations demonstrated the vulnerability of dollar-denominated assets to geopolitical sanctions. Physical gold holdings provide China with unique advantages in this environment. Unlike digital currency reserves held in correspondent banking systems, physical gold stored domestically cannot be frozen by foreign governments. That's not speculation. That's a lesson China drew directly from what happened to Russia, and they drew it very quickly. Within months of that event, the pace of Chinese gold buying accelerated in ways that the market is still trying to fully account for. For decades, China maintained significant holdings of US Treasuries, once peaking at over $1.3 trillion. But in recent years, Beijing has been slowly unwinding this position, and in parallel, its gold holdings have risen sharply, reaching over 2,292 tons, now accounting for roughly 6.5% of its total official reserves. This pivot is not merely a matter of portfolio balance. Gold is seen by Chinese policymakers as a strategic asset that offers insulation from geopolitical risks, especially US sanctions and financial coercion. And here is what makes this particularly interesting. That 6.5% figure is still very low compared to major Western central banks, which means there is enormous room for China to continue accumulating. This is not a strategy that has run its course. This is a strategy that is still in its early innings. For 15 consecutive months, leading into early 2026, China has been a net buyer of gold, pushing its reserves to a record 2,308 tons and helping drive the price of the precious metal above the historic $5,000 per ounce mark. Read that again, gold above $5,000 per ounce, and China is still buying, every month, consistently. That is not the behavior of a country that is uncertain about its direction. That is the behavior of a country that has made a decision, a long-term strategic geopolitical decision, and is executing on it with the patience and discipline that authoritarian systems can sometimes afford. Now let's talk about what China is doing with those treasuries as they sell them, because this is where the story gets even more layered. There's a narrative circulating that China is simply dumping bonds on the open market and causing yields to spike, and while there is some truth to the yield volatility we've seen, the full picture is more sophisticated than that. China uses countries like Belgium and Luxembourg for custodial purposes, in particular Euroclear Bank, which is based in Belgium and sits at the center of cross-border settlement and collateral mobility. While China's official treasury holdings have fallen significantly, Belgium's reported holdings rose by roughly 500 billion over the same period. In other words, China hasn't necessarily sold everything it appears to have sold on paper. Some of it has simply been moved, repositioned in ways that reduce the political and geopolitical visibility of the holdings while maintaining flexibility. This is sophisticated financial statecraft. This is not a blunt instrument, this is a scalpel. But here's the thing. The direction of travel is still unmistakable. The share of foreign ownership in the US Treasury market has been declining over the last 15 years. While foreign investors remain the largest constituent within the Treasury market, their share of ownership has fallen to 30% as of early 2025, down from a peak of above 50% during the global financial crisis. So we are talking about a structural long-term shift in who is willing to hold American debt. This isn't just China, this is a broader recalibration by foreign official institutions who are looking at the trajectory of US deficits, US political dysfunction, and US willingness to weaponize the financial system, and concluding that maybe they should hold a little less of that paper. The dollar's share in global foreign exchange reserves has slid to a two-decade low. De-dollarization is most visible in commodity markets, where a large and growing proportion of energy is being priced in non-dollar denominated contracts. Now, the dollar is not disappearing tomorrow. Let me be absolutely clear about that, because nuance matters here. The BIS 2025 Triennial Central Bank Survey found the US dollar was on one side of 89.2% of all foreign exchange transactions in April 2025, up from 88.4% in 2022. Global FX trading hit $9.6 trillion per day, and the dollar's share actually increased. So you have this fascinating paradox. The dollar's share of reserves is declining, but its share of daily transactions is holding or even growing slightly. What that tells you is that the dollar's erosion is happening at the foundational structural level of what central banks choose to hold as a long-term store of value, not yet at the transactional level of daily commerce. The dollar is still the operating system of global trade, but countries are quietly beginning to back up their data onto a different server, and this is precisely what makes this moment so historically significant. We are not watching the dollar collapse. We are watching the very early stages of a process that historically takes decades, but that doesn't mean it's not real, and it doesn't mean it has no consequences for ordinary Americans in the near term. The immediate implications of the Chinese sell-off are being felt across the yield curve. With one of the world's largest creditors stepping back, the 10-year Treasury yield has recently spiked, creating what analysts call a bear steepening effect that has rattled equity markets and increased borrowing costs for American consumers. Higher borrowing costs, that's not an abstraction, that's your mortgage rate, that's the interest on your car loan, that's the credit card balance that's now a little harder to pay down. This is how geopolitical shifts land on kitchen tables. The timeline of China's retreat traces back to the escalating trade and technology restrictions of 2024 and 2025, which convinced Beijing that financial sanction-proofing was a national security priority. By reducing its exposure to the dollar, China aims to insulate its economy from the potential weaponization of the US financial system, a lesson learned directly from the freezing of Russian foreign reserves in 2022. And Washington's response to this has been, in my view, one of the most strategically short-sighted approaches imaginable. Rather than asking the question of why America's allies and rivals alike are stepping back from the dollar, the response has been to threaten. US President Donald Trump has explicitly opposed BRICS's financial independence efforts, warning that any attempt to bypass the dollar would lead to a 100% tariff on BRICS exports to the US. Think about what that tells you about the underlying confidence in the system. When you have to threaten people to continue using your currency, you have already lost the argument. Now let's talk about the infrastructure being built to replace dollar dominance, because this is the part that most financial commentators either miss or deliberately ignore. China's cross-border interbank payment system, known as CIPS, processed the equivalent of $245 trillion in yuan-denominated transactions in 2025, real operational infrastructure that provides a settlement alternative to dollar-denominated SWIFT channels, $245 trillion worth of transactions flowing through a system that bypasses the dollar entirely. That is not a pilot program, that is not a theoretical future, that is happening right now. Systems like M-Bridge enable instant payments between central banks in China, Hong Kong, Thailand, and the United Arab Emirates using digital national currencies, and the system processed the equivalent of $55 billion in payments, with 95% of transactions denominated in digital yuan. Russia and China now settle around 90% of their bilateral trade in rubles and yuan, bypassing the dollar entirely. 90%. Between two of the largest economies in the BRICS bloc, the dollar has already been essentially eliminated from bilateral trade. Now, China-Russia bilateral trade is not the entire global economy, far from it, but it demonstrates that the alternative infrastructure works. It demonstrates that it is operationally viable. And it demonstrates that the psychological barrier of imagining a world where the dollar is not the only option has already been crossed in at least some significant corridors of global commerce. A partial fragmentation of the global payment system is underway. That is how serious analysts at major policy institutions are now describing what is happening. Not a fringe view, not a conspiracy theory, a partial fragmentation of the global payment system. The single most important infrastructure underpinning American power, the dollar's role as the world's reserve currency, is beginning to splinter along geopolitical fault lines. And then there is gold. Let's come back to gold for a moment, because it is central to this entire story in a way that is not fully appreciated. Gold had already been on a strong run in 2025 when it repeatedly set new records, and its price ultimately surged 64% over the year, its largest annual gain since 1979. Momentum carried into early 2026, when gold climbed above $5,100, driven by safe haven demand amid geopolitical tensions, expectations of looser U.S. monetary policy, strong central bank purchases, including China's continued buying streak, and record inflows into exchange-traded funds. Gold at $5,000. Think about what that number is telling you. When every central bank on earth is buying an asset that produces no yield, no dividend, no cash flow, when they are choosing it over US Treasury bonds that pay interest, they are making a statement about their confidence in the global monetary system. They are saying, we prefer something that cannot be printed, cannot be frozen, and cannot be weaponized over a piece of paper issued by a government that is running trillion-dollar deficits and using financial access as a tool of foreign policy. Reports suggest the People's Bank of China may be buying 5 times more gold than it discloses to the IMF, with real reserves potentially surpassing 5,000 tons. This opacity is deliberate. By quietly shifting reserves from dollars into gold, China avoids alarming markets while progressively building leverage. 5,000 tons of gold potentially sitting in Chinese vaults, largely hidden from the official accounting. That is the kind of strategic patience and discipline that should command our attention, whatever we think of the Chinese government. They are playing a very long game, and they are playing it quietly. The freezing of $300 billion in Russian reserves in 2022 highlighted vulnerabilities in Western custody, prompting central banks to diversify. In 2022 alone, official sector gold purchases hit 1,037 tons, the highest since 1967, and they have not stopped. The World Gold Council reports that central banks purchased 1,045 tons of gold in 2024, the third consecutive year above 1,000 tons, and more than double the 473-ton annual average from 2010 to 2021, 3 consecutive years of record or near-record central bank gold buying. This is not a coincidence. This is a coordinated global reassessment of what constitutes a safe reserve asset in a world where the line between finance and geopolitics has essentially disappeared. Now, what does all of this mean for you, for regular Americans trying to navigate this world? I think the honest answer is that this is one of those situations where the consequences are real, but the timeline is uncertain. The dollar's reserve currency status is not going to disappear in the next year or even the next 5 years. The institutions, the infrastructure, the legal frameworks, the sheer depth of US capital markets, all of these things provide enormous inertia. Historical precedents suggest similar timelines for dollar adjustment. The British pound's decline from 65 to 70% of global reserves around 1913 to negligible levels by the 1960s required approximately 40 to 50 years. We are likely talking about a generational shift, not an overnight crisis. But here is what matters about that. Generational shifts begin with the kinds of decisions being made right now. The choices that central banks are making today, to buy gold instead of treasuries, to build payment systems that bypass SWIFT, to settle trade in local currencies, these are the decisions that, compounded over decades, produce a different world. And the people who understand that the shift is underway, who position themselves accordingly, who don't wait until the mainstream media finally declares that yes, the dollar era is ending, those are the people who will navigate what comes next with their financial well-being intact. Modern financial infrastructure enables faster transitions than previous eras. Digital payment systems, bilateral swap arrangements, and central bank digital currencies provide alternative infrastructure that didn't exist during earlier reserve currency shifts. These technological advances could potentially accelerate the current de-dollarization trend beyond historical timelines. That is the variable that historical analogies don't fully capture. The world in which the British pound declined had no internet, no digital settlement systems, no central bank digital currencies, no instant cross-border payment networks. The technological acceleration of our era means that what took 40 years before could happen in 20 or in 15. We genuinely do not know. And that uncertainty itself is something that should inform how seriously we take the signals we are seeing today. What I keep coming back to is this. The relationship between China and US debt is not just a financial relationship. It has never been purely a financial relationship. It has always been political. It has always been about power. And when you watch that relationship unwind, when you see a country that once held over $1 trillion in your government's debt now systematically reduce that position and replace it with gold and alternative financial infrastructure, you are watching a geopolitical statement being made in the language of finance. China is saying very clearly, we no longer fully trust the system you run. We no longer want our security to depend on your goodwill, and we are building the roads that will allow us to travel without your permission. Whether you find that threatening or understandable or some mixture of both probably depends on where you sit. But what it cannot be is ignored. The world is being restructured, quietly and deliberately, in boardrooms and central bank meeting rooms and diplomatic summits that most people never hear about. The dollar's era of unchallenged dominance is not over, but the challenge has begun in earnest. And the $700 billion question, or more accurately, the several $100 billion that have already moved out of US Treasuries and into gold and alternative systems, is not really a question about money at all. It is a question about who holds power in the next chapter of the global story and who gets to write the rules that everyone else has to live by. That is what is actually at stake here, and that is why this conversation matters.